Well, as we've been telling you, Citigroup may sell control of its Smith Barney brokerage business to Morgan Stanley. A deal could be announced as early as today. We're joined by Stuart Plesser, analyst at Standard & Poor's, who has a hold rating on Citigroup. Stuart, nice for you to join us.
Good to be here.
Okay, so how much is this going to help Citi's balance sheet?
Well, it's certainly going to be a near-term help in terms of that they're going to be able to write up the remainder of their Smith Barney holding and improve capital ratios on that basis. But over the long term, we think that they need to sell further assets or have an equity raise of some sort to improve their capital base.
Well, what's next on the sale block, do you think?
Well, there's a lot of names that they have possible to sell. Prim America is one, consumer finance businesses. There's a couple of issues. One is, what is the market willing to buy at this point? And it's a tough market to sell assets. The other is, what is management willing to sell at this point? They seem to be wanting to go along a course of, seeing how their capital ratios go, seeing what securities write-downs hold in the future before they let go of some important assets. And then you also have the government part of the process there, perhaps urging Citi along to sell these assets quicker than management may want to. Right.
There's some implications there about the government involvement in this brokerage deal. But the question, of course, is why is it the obvious route for Citi to sell these assets versus just breaking up the company?
Well, I think it's management's goal perhaps right now to see what's intact at the end of the credit crisis and keep the company as intact as possible. And this is even a half step. They're not, this pending deal that hasn't really been announced complete yet is only selling half of the Smith Barney operation. So management wants to go at it in a very gradual process and try and keep this company intact, waiting for the credit crisis to be over with.
But the reality, of course, Stuart, as you know, the stock went down 17%. It's still falling right now in pre-market trading. So there's certainly a lot of dissatisfaction among investors. If the management is making the right steps to shore up their capital base, why this negative reaction that you're seeing?
Well, I think that investors are looking and saying this isn't the only step that is needed. It's also a combination of the reason for the sale is likely that fourth quarter is going to be a lot worse than investors had expected. So a combination of the two is pushing the stock down as we speak. And
speaking of the stock, I know a lot of people are eyeing the price of $377 because that's the 15-year low that it hit back in November. Is there any type of trigger point, do you think, Stuart, at some point where Citi says they give up their hands and they say, you know what, we're going to have to break up the company?
That's the dire scenario, and if it came to that, it's a matter of survival. I assume anything's on the table. But right now, they're going at it in a more gradual process, probably hoping that the securities markets pick up and they're able to, these write-downs of their securities are able to stem at some point and not take the kind of losses that they have up to now.
Very quickly, Stuart, what is your estimate in terms of their write-downs or their losses?
Well, we're at the realm of having revised our earnings for Q4 near the $10 billion loss for fourth quarter in terms of provisions and heavy security write-downs.
Okay, Stuart, great for you to join us. Thank you so much. Stuart Plesser, analyst at Standard & Poor's, talking about the Citigroup Morgan Stanley possible